Welcome to the Deep Dive, where we cut through the noise to bring you the insights that really matter. I'm John, part of the staff here at WeWire.
And I'm Wendy, also from the WeWire team. We're the ones who put together your weekly StayWired recap each week.
That's right. We distill the key nuggets from finance and, well, beyond, really. All tailored for you.
And this week, John, we're diving into something I found genuinely eye-opening, especially the numbers.
Absolutely. We're talking Gen Z and financial advice. And get this, a Bankrate and Terrify survey. It reports 22% of Gen Z rely on TikTok for financial advice.
22% on TikTok.
Yeah. Compare that to only 16% who use conventional financial advisors.
That's quite a gap already. And, other sources back this up. Business Insider found similar things.
Right.
They cited 34% of Gen Z looking for advice on TikTok, 33% on YouTube, and traditional advisors, only 24%.
So significantly more on social media. And there's more. Wall Street's poll found, 76%?
76%, yeah. Using platforms like TikTok and YouTube for money matters, it's huge.
It really is.
And this isn't just like a passing phase. It feels like a really profound shift in how a whole generation thinks about financial guidance.
So our mission today, really, is to explore why. Why is this happening? What does it mean for finance?
And crucially, what does it mean for you navigating this changing financial world?
Okay, so let's try and unpack this a bit. The big question, I guess, is what's pushing Gen Z away from the traditional institutions? Because people are worried.
Mm-hmm.
We're hearing alarm bells from the established players. I saw one Wall Street exec quoted saying, what we don't want is young people getting their financial information on TikTok. That's really frightening.
You can understand the concern from their side, but it really points to a profound trust gap. There was this global survey.
Yeah, okay.
It found only 32% of Gen Z trust banks with their personal data.
Ugh.
32%.
And older groups?
Much higher. 51% for those 55 and older. You have to remember, this generation grew up, seeing major financial crises like 2008.
Right, the fallout from that.
Exactly, and constant news about data breaches. So it's maybe understandable there's this deep skepticism.
So they see banks as maybe outdated or opaque.
Yeah, perhaps not always acting in their best interests. That seems to be the perception for quite a few.
Okay, that makes sense. So if they're not going to the traditional banks or advisors, where are they getting guidance? You mentioned the platforms, but who on those platforms?
Well, the sources suggest they're leaning towards what they see as more relatable sources, friends, family, and this new wave of finfluencers.
The financial influencers.
Right. Yeah, these social media personalities giving out money tips. They've really tapped into something. Gen Z wants accessible, relevant info.
There was that CFA Institute study, wasn't there? It mentioned how some top TikTok creators use really plain language storytelling.
Exactly. Quick visual lessons, things that really connect with younger viewers. I read about the founder of one big Gen Z finance channel on TikTok.
Mm-hmm.
Their whole strategy is breaking down complex stuff like compound interest into these super digestible short clips.
Which sounds helpful, actually.
It often is. What's interesting is they're not always peddling crazy schemes. A lot of influencers echo really sound advice, Build an emergency fund. Avoid high-interest debt.
The basics.
The basics, yeah. But they do it in this authentic, entertaining way that, frankly, traditional finance has struggled to match until very recently. It's about meeting people where they are.
And the big players are noticing now. We're seeing major asset managers trying to sort of copy that style.
Like BlackRock.
Yeah, BlackRock's on TikTok now. They're putting out videos on retirement, inflation, all in those short, snackable formats. It shows they recognize the power of it.
It definitely does. But, you have to wonder if just adopting the format is enough. Does it really bridge that trust gap? Or is something more fundamental needed?
Well, this is where it gets really interesting, I think, because traditional finance is definitely scrambling to respond. Reuters had a piece on this.
Right.
Firms like Fidelity and BlackRock, they're not just starting TikTok accounts. They're actively partnering with popular creators, trying to deliver credible info within that whole FinTalk world.
So using the influencer's reach and credibility?
Exactly. Fidelity's head of marketing even admitted it's a challenge. You have to take these complex topics and explain them in like a very short period of time to keep Gen Z engaged. It's a totally different way of communicating.
And despite these efforts, you still get the sense that many firms are, uncertain. How do you really match that appeal, that perceived transparency of social media?
It's tricky.
It is. And this shift, it has wider implications, doesn't it? It's not just about individual advice. Think about Gen Z's growing market influence.
Oh yeah, the meme stocks, crypto waves.
Yeah,
A lot of that fueled by social media chatter.
precisely. So if young investors keep getting their education or maybe their miseducation online, what does that do? Could it mean more market volatility, less loyalty to the old institutions over time?
These are big questions. So what's
Yeah.
the path forward then? For the institutions, for regulators, what do they need to do?
Well, it seems pretty clear they need a major strategy shift. Things like collaborating with credible creators. That's key.
Right, vetting them properly.
Definitely. And embracing real transparency. Plus, actively promoting digital financial literacy. Earning Gen Z's trust needs more than just slick videos.
What does it need?
Clear, honest explanations about data use. Robust customer protection that feels genuine, not just like ticking a legal box.
Yeah, authenticity again.
It always comes back to that. As one analyst put it, Gen Z is highly informed and deeply skeptical, so vague reassurances won't cut it.
That sums it up well.
It does. Wall Street's future, you could argue, really depends on meeting Gen Z, where they are places like TikTok, but with accurate information and a modern outreach style. The old ways just won't fly anymore.
That's a really fascinating look at this shift.
Yeah.
Okay, before we move on, maybe let's just quickly nail down our top 3 insights from this part.
Good idea.
Okay, first, I think the core insight isn't just Gen Z is on TikTok. It's that traditional finance fundamentally misunderstood the language of trust for this generation.
Right. A language built on authenticity, access, transparency, not just authority or legacy.
Exactly. Second insight, maybe that the breakthrough isn't just being on TikTok, but understanding that short form isn't just about length.
It's a different way of processing information.
Yeah, like a cognitive model that values engagement, instant relevance,
Yeah.
over just sitting through a long explanation.
Okay, makes sense. And third.
Third, Wall Street scramble isn't just marketing. It's really a fight for future relevance. It's about redefining what financial authority even means in this digital age. Adapting to survive, basically.
Good points. Authenticity, engagement, adaptation.
Right. Okay. With those insights in mind, let's broaden out. Let's look at the wider financial landscape in this week's market movers.
Sounds good.
Starting in Europe, Poland's central bank caught my eye. They boosted their gold reserves significantly to 30% of assets.
Wow, 30%. That's a statement.
It is. And it sort of reflects a wider trend, central banks diversifying, hedging against uncertainty. Plus, their economy is doing pretty well, outpacing many EU neighbors.
Interesting. And over in the U.S.?
Some fairly encouraging signs. Retail spending picked up in August, suggests consumers are still spending.
Okay.
Combine that with fairly tame inflation figures. And it boosted hopes for potential Fed rate cuts. So shares gained a bit, bond yields eased slightly.
Market liked that combination.
Seems so. Oh, and also Klarna, the buy now, pay later company, they debuted on the NYSE. Valuation near $20 billion.
Still huge appetite for fintech then, especially in payments and credit.
Definitely.
Okay, turning to Africa. Uganda's been a notable growth story recently, averaging 8% annual growth over the last 5 years.
Impressive. What's driving that?
A lot of it is boosted by their developing oil sector. Meanwhile, Nigeria made a move to delay a new tax law until 2026.
Why the delay?
Seems to be concerns it would worsen living costs right now, so a focus on stability for the population.
Got it. Okay, FX Corner for Africa.
Right. The Ghanaian cedi versus the U.S. dollar. Well, it's continued to struggle. Down quite significantly year to date, one of the weakest performers.
Okay. And on the flip side?
The West African CFA franc against the dollar has been notably resilient this year. That's largely thanks to its peg to the euro, providing some stability there.
Interesting contrast. And globally.
The British pound against the U.S. dollar had a good week, rose about 1.04%.
What lifted it?
Stronger than expected UK labor market data, mainly, suggests some underlying economic health, pushed its year-to-date gains up further over 5%.
Okay. And the dollar versus yuan?
The dollar weakened a bit against the yuan. The People's Bank of China, the PBOC, kept a firm policy stance, seems to signal continued preference for yuan appreciation.
Right, reflecting their economic priorities. Okay, quick look at commodities.
Sure, commodities corner this week, kind of a mixed bag. Oil prices generally trended down.
Brent and WTI both.
Yeah, Brent slipped towards $65, WTI towards $61, roughly. Mainly concerns about global oversupply and maybe softer demand than expected.
So a cautious outlook for energy use.
Seems that way for now. Gold, however, was the opposite story.
Extending its run.
Fourth straight week up. probing near record levels, actually, above $3,640 an ounce.
Wow. What's driving gold?
Mostly softer U.S. economic data like jobless claims, plus those mixed inflation signals. It all strengthens the market's bet on potential Fed rate cuts.
Making gold, the safe haven, look more attractive.
Exactly. When rates might fall, non-yielding gold becomes more appealing.
Makes sense. And just quickly, for listeners wanting more detail on specific stocks, the full statewide recap does have insights on most active stocks.
Right. Potential ideas there.
But, and this is crucial, the usual reminder,
Yeah.
everything we've discussed is for informational purposes only. It's absolutely not financial advice.
Please always do your own research or talk to a qualified financial advisor before making any investment decision.
Definitely. Remember, past performance doesn't guarantee future results.
Absolutely.
Okay, so bringing it all together, Wendy, what does all this mean for you, our listener?
Well, I think the big takeaway is that the financial world is changing incredibly fast. From how you might get personal advice like we discussed with Gen Z and TikTok right through to the big global market forces.
That's a lot to keep track of.
It really is. And as information explodes, especially in these, bite-sized, often entertaining formats, the need for you to stay informed is critical.
But not just informed, right?
No, perhaps even more importantly, you need to critically evaluate where that information is coming from. In this sea of information, discernment, that ability to judge well, that's probably your most valuable asset.
Well said. Discernment is key. And maybe here's a final thought for everyone to mull over this week.
Okay.
If the next generation of investors, Gen Z, is largely being shaped by short-form video, what new skills become most crucial for navigating finance effectively? And, kind of related, where does the real power to inform, or maybe misinform, actually lie now?
That is a provocative thought. Where does the power lie? Definitely something to reflect on in this dynamic world.
Well, that's all we have time for on this edition of The Deep Dive, brought to you by WeWire's weekly StayWired recap.
Thanks so much for tuning in.
We'll catch you next time.
StayWired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the StayWired Weekly Recap.